solve this problem on your own, the process listed here is helpful. So step 1 in documenting our assumptions, high-speed copier will create income statement related item that we know as revenues, new revenues of $10,000 per year. The copier will be depreciated. Anytime we see that, we know we're going to have a depreciation expense to deal with on a straight line basis to a salvage value of 0. So it looks like we'll be buying a copier for which then we'll have a balance sheet to concern ourselves with, where we have a salvage value of no dollars, where we have a useful life expressed in years of 5, and we're going to have all of that begin because we buy a $25,000 capital item that is our copier, and that's its cost, where we'll eventually going to use the rate of 8% to figure out our NPVs. Since the problem indicates that we are using straight line depreciation, the formula we will use will be the cost minus the salvage value divided by the numbers of useful life, and that will give us our depreciation expense that also will apply every year. Building out now an income statement, we can make a fairly simple one. As you saw in the solution, we only really have a few items to deal with. So I'm going to copy and paste from the solution over here the income statement items that are relevant to us. So we will have year 1 through year 5. And the income statement in here that we'll have revenues first and foremost. In year 1, they will be equal to $10,000. Hit F4 since those don't change. Copy and paste it across. The only expense that we have is the $5,000 depreciation. That won't move either, so we do our fixing of it by putting our dollar signs. Because there's no tax, we can get right to net income here, so that this new copier will add $5,000 in new net income every year. What we want to now do is determine the present value of all of those cash flows. So if we think about periods again, this time we need a period 0, as that will be the time when we buy the copier, and we will go out for 5 years. We have cash flows in and cash flows out and cash flows net, for which we calculate the present values, then NPV and IRR. Cash flows in are always going to be equal to revenues. Cash flows out would be equal to any cash expenses, but we don't have any actual cash expenses. Depreciation is a non-expense item, so we can just indicate that there's 0 output cash flows out, thereby cash flows net equaling in minus out tells us that the net effect is really $10,000 in cash flows net every year. How does that all start? Well, in the first period, we have to buy, not in the first period that's shown in column B, meaning period 0. So then in period 0, we're actually losing cash flows of $25,000 as we purchase the item. So now we want to calculate the present value when our rate is 8%, which doesn't move, so we can fix it, where this is in period 0. There's no payment, so I'll move straight through that field. And then so the numbers show up on a positive basis when positive and a negative basis when negative. I switch the sign on the cash flows net as my future value, and then see that it is $25,000 out that gets me started. If I were to copy and paste that into the first adjacent cell then, and we look, we would see we're using again a rate that's fixed at B14. This time we are C23, 1 period away, where our future value is negative C26, and that gives us then the positive result of $10,000 that comes in 1 year at a rate of 8% is worth to us right now $92.59. Copying and pasting that across, we get all of our positive cash flow values. Now notice something happened bad there. So what did we do wrong? Let's try and copy and paste it into the right row this time. So that at the end, if we look back to our process, we built this model. Now let's go ahead and look at IRR and net present value, which would be our two answers. The net present value is just simply the sum of all the present values from period 0 through the end. And the IRR is a formula in Excel where equals IRR, and then the values you use are the cash flows net. And so we have a project here that offers us a net present value of $14,927, or approximately an IRR of 28.65%, which is what we saw in the file solution sent earlier.